Hello everybody and welcome to February's edition of Payroll Question Time. We're going to be going back to something that is always popular on today's show, which of course is payrolling benefits in kind. We got loads of questions on this last time round, so if you've got more, remember to put them in the questions box. We're going to do our best to answer all of those questions during today's episode. Of course, not a huge amount has happened since the last episode. There's been a few updates. I think the HMRC has published guidance on the rates and thresholds for employers for 25-26. There's been a release regarding advisory fuel rates to use from the 1st of March. And they've also issued a P800 tax calculations for the last tax year as well. But I'll let our panel run through those when we get there. If you are joining us for the first time today, please, if you have any questions, whatever they might be about payroll, they do not have to be related to today's episode. Please do put them in the questions box. We'll ask our panel all of your questions in real time, and we'll do our best to get the best answers we can for you to those challenges. No such thing as a bad question. If you're struggling with something in payroll, it's likely that someone else on this show who's watching is struggling with the same thing as well. So please do be really active and flood me with questions, and I will then flood our panel. We're going to be also running 2 polls today, so that's our opportunity to ask you what you think with regards to the questions we're going to pose to you. So please get your fingers at the ready for the buzzers when those polls go live, and we will comment on those results as well. We are, of course, recording this session, so you don't need to be busy scribbling notes. If you've registered, you will get a copy of the slides after the session is over, which is hopefully something good. You're also going to get a survey as well. That survey is really, really important. It's your opportunity to let us know here at PQT what you want us to cover in the next episode of the show. So if there's something that you really wish we'd covered already, or you're wondering why we haven't covered it yet, that's your opportunity to let us know. Just going to finish with a little disclaimer for those that are new. This is really important. It just says the presentation does not provide definitive answers to individual queries, and in some places takes views on matters which are uncertain. It is not intended to be relied upon in any specific context or as a substitute for seeking legal advice or otherwise on a specific circumstance, as each case may be different. Right, lots to get into today, so let me introduce you to today's panel. I'm going to start with myself. I'm the host of today's show. My name is Nick Day. I'm the CEO of JGA Recruitment Group. We're a specialist payroll recruitment company. I'm also the host of the Payroll podcast, where you will indeed get a copy of this audio in a later episode. So if you subscribe to the channel, you don't quite catch everything today, or if you have a colleague who you said, oh, you should have been on today's webinar, that's your opportunity to share it through the podcast. But that's enough about me. Let me lead you to our panel. I'm going to start with my left to right, which from my view is Andy Nichols. If you can introduce yourself, please.
Hi everyone. Yeah, Andy Nichols. I've worked in payroll and pensions now for about 40 odd years. Just here to help with any pension, really, more so than anything else. So looking forward to your questions and just going through the slides.
Because Andy wasn't with us last episode, but we had loads of pensions questions. So again, if you didn't get your question answered last time and it was pensions related, this is your opportunity to do so. Moving forward to Simon Parsons, if you can introduce yourself, please.
Yeah, good afternoon, everyone. Simon Parsons, Director of UK Compliance Strategies for SD Worx UK, and it's good to be with you. I'm a fellow of the Chartered Institute of Payroll Professionals, have the MSc in Payroll Management, been around a long time, sit on a number of consultation groups and panels, as does Karen, as does Matthew actually as well, the EPG, the Rep Body Group, and the Statutory Payments Consultation Group, and various others with DWP and DBT as well. So it's good to be with you. Looking forward to hearing what you want to hear about.
Super. And moving along, Matthew Aquick, if you can introduce yourself, please.
Hi everyone, I'm Matt. I'm Policy and Research Officer at the CIPP. So the CIPP obviously being the Chartered Institute for Payroll Professionals, here to represent payroll professionals in everything that we do, whether that's the government forums that Simon's mentioning. We've got education and our consultancy arm of the business. So really putting payroll at the centre of everything we do. I'm the baby of the group with probably comparatively little experience compared to everyone else on the panel, but I do my best and try and swim with the big dogs.
It doesn't show, Matthew. It doesn't show. And last but not least, Karen Thompson.
Good afternoon, everybody. I'm Karen Thompson. I am partner and head of payroll services at Armstrong Watson for the day job. I'm a chartered member of our institute, member of the Reward 300 group, and as Simon said, sit on a number of government forums, for which I must give my apologies now. I will need to leave this important panel at around 2:55 p.m. because I have an engagement with the Department for Business and Trade to look at at or discuss the employment rights and workers' rights and everything else at 3 p.m. So forgive me and my apologies.
I'll be sure to give you a question at 2:55, Karen, just to catch you out. So let's jump into today's discussion topics then. We've got a few things we're going to run through today. We're going to start with statutory neonatal pay. We're going to be talking about payrolling, benefits in kind, salary sacrifice, pension reforms, any other hot topics or any other questions we haven't covered by that part in the show. And we're going to finish with the latest from the SD Worx Academy, which is worth hanging around for. Lots of free and available courses you can access covering everything at the A to Z of payroll. So hang around if you have anyone you think you might want to enroll on one of those courses within your team, or even yourself as well, of course. We've already had our first question come in, so thank you very much, Helen. It just says, I'll give this one to you, Simon. It's an SD Worx related question. When do I need to contact SD Worx to enable our company to action payrolling benefits in kind from April 26 when it becomes mandatory?
Okay, get your project in some sort of order and contact us as soon as possible. For April 26, you've got a little bit of time. If you were going to say you're going to go for April 25, I'd be in a bit of a panic because you're leaving it very late and close to the wire. But I suggest the summer. So 2 or 3 months time, make contact with your account manager and we'll set it in motion. We've been doing payrolling, of course, for probably about 20 years, but certainly formal payrolling from when it was introduced in April 2016. So that's nearly 9 years ago when formal payrolling first came along, and I was part of the Office of Tax Simplification that actually discussed and brought in the proposal to HMRC for what was then the only proposal, voluntary payrolling, not mandatory payrolling.
Excellent. So she has a little bit of time, which is good to hear. And thank you for putting the first question in the box to begin with. Well, let's jump into our first subject. And I'm going to get Simon to also introduce this to us. I'm going to actually disappear just for a second while he does so. We're going to talk about statutory neonatal pay. So Simon, if you can give us a bit of an overview, start letting us know what the changes that are coming in April 25, whether we are indeed ready for a neonatal tax system at all, and of course, most importantly, what this means for employers.
Yeah, sure. So I'll try and do my best. I'm sure Matt will dip in as well as and when, because it is a little bit of an evolving field and the legislation is going through Parliament at the moment. Some of it has gone through, some of it is still to go through, and guidance is out in some form, but not in its final formats. So statutory neonatal pay, or even leave rights as well, gives a day one right to those who have a baby that's admitted into neonatal care, but there are a couple of factors. The first is it doesn't apply until live births from the 6th of April 2025. So it's not related to when the baby is due, it's related to when the birth occurs. So it applies to all babies born on or after the 6th of April. And then the neonatal rights comes into play 7 days after the first full day that they are admitted into neonatal. It seems a bit balmy, some of the announced in the legislation, but the first 7 days are dealt with by employer policy, not by statutory right. So the entitlement to leave and pay occurs from the 7th day after the first full day. So let's try and get that in context. If the baby was born on the 6th of April and was admitted into the neonatal care unit that day, the first full day of neonatal care is the 7th. Then the right to neonatal leave and pay if they qualify, meeting the earnings and length of service right, is 7 days later, so the 14th of April onwards, and it's that sort of rolling period. So the first 7 days is an employer problem. After that, from day 8, the right is there from the prior 7 days. So it's got this sort of looking back, arrears aspect to it, and potentially there is 12 weeks of rights to neonatal leave, And there are two aspects. They call it Tier 1 and Tier 2. Tier 1 statutory neonatal leave is when the baby is in the neonatal unit and the following 2 weeks, from memory, correct me if I'm wrong there, Matthew, but I think it's following
1 week.
1 week. That's called a Tier 1. And during the Tier 1 aspect of when the baby is in hospital, the parents can choose whether they work or have leave, but the leave is a week. It's not a day. You can't swap days. It's weeks, whole weeks, 7-day weeks. And they can choose, and you can split it. So you could have a parent that works whilst the other one stays in the hospital. Then they could swap for a week, then they could swap back, and then they could swap for a week during the duration of when the baby is in neonatal care and 1 extra week. Then it moves into the remaining entitlement of up to 12 weeks, is they can then exercise Tier 2 statutory neonatal care pay and leave, which is when the baby is home or out of the neonatal care unit. At that point, they can exercise the right to leave and potentially pay if they qualify for the remainder of the 12 weeks entitlement that there is. But that Tier 2 is one solid block, so it can't be split. It has to be taken in one continuous leave period. Now, the other factor of it, and this is where it'll start to hurt our heads a bit, and I think this is absolutely mad, isn't it, is the interaction with other statutory payment types, because of course these parents may well be entitled to statutory maternity pay, can apply to adoption even, statutory paternity pay, or even shared parental pay. So what happens then? We'll start with statutory maternity pay. Because the way the regulations are set out, statutory maternity pay must start at least by the day after birth. And it pushes the right to statutory neonatal care pay to later. So then, in effect, almost becomes a Tier 2 for the mother if she wants to take that leave. So statutory maternity pay is first, and the SNCP will be deferred till after the SMP payment is finished. Now, that doesn't apply to other statutory payments because the regulations don't define it that way, and there is more choice. So with statutory paternity pay, you've got a period where you can choose to take it. You could take the SNCP, as I'm going to call it, before, in the middle of the 2 weeks, or at the end, after. And the same with shared parental pay. SNCP can be taken before shared parental pay, during the middle of it, or after. So for SMP, not allowed. For the others, it is allowed, and it's employee choice. The rate of SNCP is the lower rate, or 90% of earnings average, if that is lower. So it's the standard rate that you have for other statutory payments. I think I've exhausted my brain at that point, Matthew and Nick. So
Do you want me to
Matthew, you
jump
may be
in?
able to. Yes.
Yeah, so it is different. It is confusing. I think for a lot of people, that first week is going to be key from a business point of view, business policy, your employment contracts or your employee handbooks, because of the way that parental leave rights work, it has to be taken in full weeks. And because of the nature of neonatal care and how it's accrued, we don't know at the point in time that you start to accrue it how long that's going to last for, which is why you've got this lag of a week where that first week technically cannot be neonatal care leave. So you as an employer need to decide, what am I doing with this? Am I doing emergency family leave, which will maintain employment rights but doesn't come with any statutory payment? So you as an employer need to decide whether you're bumping that up, whether you're leaving it as unpaid, or if you're going to try and come to some other arrangement, whether that is other parental leave rights like paternity or annual leave. But it's very important with those leave types that you realise that you as an employer cannot enforce those because you wouldn't be complying with the required notice periods. That would have to be a mutual understanding between you and the employee. A couple of other things to add in there. The 12 weeks is not shared between parents. Both parents are eligible for that 12 weeks. So it's not like shared where you have to decide who's using what of the 12 weeks. You'll both get 12 weeks, which is important if you employ both of the parents in the same organisation. That is something that potentially could come up. If there are multiple births, it's important to remember that this is an entitlement for the individual, the employee. The criteria of the neonatal care is attached to the child, but essentially the other qualifying criteria isn't for the child, it's for the employee themselves. So if there's multiple births, it's still only 12 weeks. You don't get 36 weeks for triplets, for example. It's just capped at that 12 weeks. Aside from that, yeah, as Simon said, it's the interactions around those other entitlements that are going to be key for you to understand. You know, making sure that you exercise it at the end of maternity leave, for example. That's why you've got 68 weeks to use it. So there's a time limit of 68 weeks from birth. As Simon said, don't care about due dates or anything like that. It's all around the actual date of birth. And that 68 weeks allows you to use a full maternity allowance, potentially an unfortunate situation of bereavement, and a 12 weeks of neonatal care. So we have that full 68 weeks to use all of those entitlements. But just making sure that we don't curtail maternity unless the employee specifically asks for that, because once you curtail maternity, you obviously can't go back onto that. It would be the end of that. You would use your neonatal, and your neonatal would be used and paid at the same time. You don't pay that as it's accrued, you pay it as it's used. And something interesting that stuck out to me in the guidance. So we've got draft guidance that's been given to software providers, but we don't have the full guidance yet, so we're still waiting on that. But I was looking through some of the special situations, and someone asked me a question the other day about if an employee leaves, do you still have to pay them out as you would with maternity leave? And actually in the guidance it says no, if it's not used, it's not paid, which I thought was a bit interesting. But yeah, waiting on the guidance. Once we've got more guidance, we'll be able to go into a lot more detail. But at the moment, if you want to know more, I'd really recommend having a look at the Employers Bulletin or the Agent Update, which has a little bit more information, including the notice requirements. So one last thing while I've just remembered it, the notice requirements. There is a requirement for the employee to give a declaration that they comply or that they are eligible based on the child's care received, and that they fulfill the caring criteria for the child. There is no physical document or proof that they are required to give you that the child was in neonatal care. So while it is a bit confusing for employees not to have the proof of that, it's obviously very loosely constructed to not be onerous on an employee during a time period which is probably going to be fairly stressful for them. But just, you know, for you as an employer, understanding that you then don't have really the right to ask for proof if that's not required for the statutory leave and pay.
Great. Well, as you can probably imagine, we've had several questions come in around this. Karen, I know, wants to add something, so I'll come to you first, Karen, and I'll run through the questions. Karen.
Thank you. I was just going to say, and don't forget, if you use a service provider, you're going to have to share this information with them, and there are information requirements, you know, so the name, the child's birth, if applicable. You're going to have to keep records. I'm looking here of the date the child started to receive neonatal care and what have you. So there's, once again, for certainly payroll bureaus, we're in the employment law space, because there's contractual rights for leave, but then we've got the pay space. So obviously, depending on which provider you use, or indeed if you're an employer, which software you use, you're going to have to understand what fields are going to be required. And as yet, because we don't actually have the full bits that we need, it'll be a watch this.
I've lost your signal a little bit there, Karen. While we're waiting to get your connection back, I'm going to run into the questions if that's okay. So first one's coming from Mark. It says, hi all, regarding the employer allowance that employers can offset against their PAYE NIC payments, I believe it's 10k or 15k. Is this per PAYE scheme, or is this just a one-time claim for one of your PAYE reference numbers? Any help would be appreciated. I see Matt nodding, so let's come to you for that one, Matt.
Yeah, it is not 10,000 and it's not 15,000, it's 10,500. So just above that 10,000, and it is a annual allowance that you can claim. However, if you have linked companies, and there's some guidance on gov.uk as to how you can assess whether you are a linked company, it's basically if you have if you are under the control of another company or a shared director, I believe, you will be considered linked companies. In those instances, only one company in the group can claim that allowance. So you can't claim that across multiple PAYE references if they're all linked as part of one company or one group. So you do need to check that so that you're not claiming it on your director's payroll and your weekly payroll and your monthly payroll, for example.
Makes sense. Excellent. I saw another question here. I saw that a parent might need to switch to their pre-planned parental leave, maternity as an example, partway through a week of statutory neonatal care leave. In this case, would they be paid part of the week at statutory neonatal care pay, or would they not be paid at all for those days?
So it's this is something that we're waiting on confirmation from DBT. So the current understanding that we have from them, so just to clarify on the example you gave, maternity wouldn't interrupt it because you would never have a chance to gain a neonatal entitlement before going on maternity. As Simon said, you need to go on maternity on the following day following birth. So you'll never have an opportunity to gain a neonatal entitlement before you go on to maternity. But for something like paternity, for example, if you have an interrupting leave, you can essentially stop the neonatal and then append the remaining neonatal leave on the end, provided that the interrupting leave still finishes within a tier 1 period. If it finishes in a tier 2 period, then you need to book it as tier 2. If you've got a partial week, because we have to deal with things with regards to parental leave in full weeks, what we have been told is the current understanding of the legislation is that you will pay the full week in the first partial week where you process, and then the remainder of that week that is still to be taken as leave will then be unpaid at that later point. It's very confusing because at that point, you know, are we then having to force that employee to take the remainder of the week off because they won't be paid for it? What if they say they no longer want that remainder of the week? So we're trying to receive a little bit of clarification on that point to ensure that we don't, you know, force employees to have time off and with no statutory pay for that, but also understand that we can't split these weekly payments. They have to be taken as full weeks. So in that first week, you should be paying it in full, and then the remainder of the leave taken elsewhere.
Super. And Simon,
So
I'll come to you for this one.
Sure. Because, well, if I can I stick with that one a little bit?
Yeah, of course you can.
Is that all right? So there is no daily statutory payment. There are weeks. You could have in between it a day of non-statutory payment to start another week a day or two later, but you can't split a statutory payment except within a pay period fraction, but the remaining week has to be paid, or you have to, as Matt I think hinted, unpay the payment you started, because it's always whole weeks. So and we're waiting for further clarity, but you could have someone take SNCP for a week, work for 2 days, take another week if they've qualified for it, take 2 days, pay for another week, but you can't have SPP and SNCP overlap. It's not permitted. You will lose one or the other, so the parent will need to have them starting after the completion of another statutory payment.
Well, we've had some feedback on your responses, Matthew and Simon, already, saying makes perfect sense. Thank you. It would be great to find out what DBT says on that too. So next question, are both parents entitled to 12 weeks each? Simon.
Yeah, in effect, yes. I think they need to meet the qualifying conditions, and that is the child has to be in neonatal care, and then they do get that qualification, both. Yeah, is that?
Yep, that covers it. I'm going to come back to whoever takes one. I think it's a pretty straight answer for the next one as well. Can we claim the 92% back from neonatal pay?
Yeah,
absolutely. Or the 108.5%, is it? That's going up on small employers. Yeah.
Yes, that was going to add that as well. Yeah, remember to do that if you're a small employer.
Super. Will the statutory neonatal also be added on the EPS?
Yes.
Right.
Nice easy ones.
Racking through these is good. Okay, do we know if HMRC will introduce forms like we have the MAP B1 or statutory paternity form?
As far as I'm aware, yes, there will be a non-payment form, but apart from the sort of neonatal care pay 1 form, there should be no other sort of documentation needed apart from keeping records of those declarations that we mentioned earlier and Karen mentioned.
This is slightly different than before because you've mentioned HMRC. Before, all guidance on the statutory payments tends to come from HMRC. It's jointly developed by DWP and DBT. The neonatal care guidance is not developed by HMRC at all. It's actually developed by DBT. So it would be DBT that would be creating any forms or guidance. HMRC may publish it, but they're not involved in its creation, as I understand it.
And is there a form that parents receive as well that payroll people need to collect?
No, so this is what I was saying earlier. There's no documentation that a parent will be given to prove that neonatal has been given, or there's nothing they need to provide to the employer rather. They may be given some documentation by a doctor, but there's nothing within the guidance as we currently see it that states that they have to prove with any sort of documentation to their employer. So it's just a declaration that they are eligible rather than proof that they are eligible.
Very good.
Going
almost
back to information, the employer may provide a form for them to complete for the information requirement that payroll may have to report.
The last question, and we may have covered this, but I'll ask it again just in case you need a little bit more clarity. When I came back to the call, I think we're running through this, but could one of you please give an example at all how this will work in practice?
Right, so yes, I've got some examples. They're quite visual though, but in essence, if someone is on, say, baby's born, and a parent, let's say a father, is there and plans to go on paternity leave in week 3 and 4. If neonatal care leave is, or if neonatal care is being administered within a hospital or in outreach care in weeks 1 to 5, we have 5 weeks of neonatal care leave eligibility. Now they can't start taking that from day 1 because they at that point have not yet generated an entitlement. They can start taking that from day 7 or day 8 rather, once 7 days have been completed. So they will be taking neonatal care leave from weeks 2 till 6. But if they have any sort of leave in the middle, so as I said, 3 and 4, what they will then do is they'll have week 2 as neonatal care leave. They'll go on their paternity, that interrupts, that's fine. And then they'll go back onto the neonatal care leave. As Simon said, that would be their choice because if the neonatal care is still being administered, it's tier 1, so they can pick and choose what they do. But we would anticipate that it would just be appended onto the leave. And then those 2 weeks of paternity leave that they took can then be stuck onto the end again. So they'll essentially have 1 week neonatal care, 2 weeks paternity, and then 4 weeks neonatal care leave on the end of that again. With the example of maternity, you would go immediately on maternity. So say you've got 4 weeks of neonatal care being administered, those 4 weeks would then be appended right onto the end of the maternity, whether that's after 52 weeks or whether they curtail it earlier and don't have the period of non-payment. Just add it on to the end of there, and that needs to be booked, and the notice periods are 15 days for 1 week and 2 weeks and over, is 2 weeks, sorry, 4 weeks of notice.
Okay, fabulous, brilliant. Well, I think we've had quite a few questions come in now. I think let's move on to the next session. Because
Nick,
go on, by all means.
is statutory neonatal pay, have DBT said what to do with the pension? Because I would guess the employee pays on the amount received, but the employer, I'm guessing, will be paying on what would have been paid had they not been on statutory neonatal leave. So hopefully the guidance covers that. Does it say, Nick? I suppose you haven't seen it yet properly. But
It
the
has
pension needs to be looked at.
been asked, Andy. That was certainly something the software developers have asked, and I believe it was asserted that it would be the same as other statutory payments. So as you're suggesting, and that might be a surprise to some of our listeners, employers' contributions are on full pay as if they're working, not on pay received, and employees on the employer. Including salary sacrifice cases, you've actually entered a contractual agreement for an enhanced employer contribution. That enhanced contribution is required with no salary sacrifice against statutory payments. That might be something we'll come back to a bit later, but I believe so. But there's a lot of information you could say. I'm sure we had a chat about this before, didn't we, Karen, Matt, and myself? And there's an element of, there's a lot of questions outstanding which we don't really have. The guidance, the first edition of the guidance is actually a little bit misleading. I thought, for example, its calculation of earnings just referred to an 8-week calculation of gross earnings. That's not the basis of calculation. It's related to the national insurance gross earnings, not gross pay. So there were aspects. But as I think I was saying, this guidance is developed by DBT, not HMRC. Before HMRC have issued guidance, but in cooperation with the DWP and the DBT, or what it was, BAYS, this guidance is entirely DBT's creation.
Yeah, and they are the only DBT.
I'll nickname you Hawkeye from now on, just picking it up.
Yeah, no, it's a valid point, and I think something let's explore a bit more on other aspects, Andy, in the pension section.
Yeah, okay.
Sure.
Definitely.
And also, you'll be pleased to hear, Matthew, Diane commented saying that was a great example. Thank you. There you go. I was a little bit disappointed didn't put on the voices. I was putting a little bit more acting to come out with the examples, like the parent. But hey, I won't critique the knowledge. Well, let's move into the next section then, because we've got a lot of questions on this in our last episode, and actually every time we talk about it, we usually get a lot of questions. So I want to make sure we give our audience enough time to pose their questions in as well. Let's move over to payrolling benefits in kind. We're going to just update everyone on the latest, the double taxation myth, registration, yes or no, getting ready for April 26, what's easy, what's hard, the journey and impacts. Karen, I know that I haven't come to you with some of those questions, so let me come over to you a little bit. Maybe you can give us a little bit on the latest, if you may.
Yes, and apologies for internet. I've now switched to an e-mobile to make it more secure. We're getting fibre at last, but it's causing havoc as it goes in. Well, the latest that I know is we have no more news. We are really struggling. There's a lot of pushback in the industry to delay this to 2027, simply because we are now, can't believe it, end of February of 25, and we still don't even know what's going to be required. We suspect, and we know Class 1A, for example, is going to be reported at the time. It's going to be, but Class 1A has always, traditionally been a bulk and an employers only NI, but this is going to have to be sort of by employee. But we need software. How are we going to report it? And then when you're looking at, as an agent, what do we need from clients? And we've got clients asking us all the time, what is it we're going to do? Because it's, we know at the moment voluntary is okay in the fact that other than cars, you bulk it all together. And it's reportable. The Class 1A is reported P11DB at the end of the year, job done. But with this one, we think it's going to be perhaps by component, just like the P11D, with the exception, of course, of loans and beneficial loans and accommodation. But if you do want to do that, you can voluntarily do that. If you're voluntarily doing it, does that mean that you'll need to register to do that voluntarily? because why would you need to register for payrolling of benefits if it's mandatory for anything else? So to be fair, Nick, you know, we are really in a challenging situation at the moment. We know we've got to do this, whether it's 26, 27, our concerns, our timings, our software clearly is not ready because it does not know what to put in it. And it will be a fundamental change. I do think that's important to stress, is it's not going to be as it is now. It will be something different. There will be more information potentially to report. And again, I come back to, you know, as an employer, you know, if you have medical benefits, for example, that you're reporting, you know, it may be that might be all you have. But if you, you know, if you have multiple benefits and if you use a provider of some kind, they're going to need to get the information from you, which then does lead, I think, into another area that I think still needs to be considered, which is advice. You know, so if you've got payrolling of benefits and, you know, at the moment P11D, you may get that done by a tax agent of some kind. You may not do it in-house at all. Your agent may not do it if they're a payroll agent, perhaps, certainly P11Ds. So what happens if you then, you know, I'll use double cab pickups as a classic example. You have them. Is it a car or is it a van? Now, we know HMRC would like to treat them all as cars, you know, but is it? So where do you go for that advice? Many payroll professionals will have a knowledge of BiCs, perhaps a greater understanding, but will they have sufficient knowledge, or do you need to start considering now looking at benefits in kind, as in it's taxable, are they nickable, and where do you go when somebody says, the employer says, or you know, directors that say, we'd like to introduce X, how will this be impacted in respect of benefits in kind? Who is going to answer that question for you? Is it you with the knowledge, because it is viewed as tax advice? As far as if you take professional bodies like ICAEW, so the Institute of Chartered Accountants for England and Wales, or the same for Scotland, you know, it is viewed as tax advice in their eyes. So who will give you that advice? So I think for me, whilst we don't yet have what we need for payroll as far as component levels and what we're going to need, I do think we do have an opportunity at this point to start considering some of these wider topics on how you will deal with benefits in kind, particularly where employers are looking to try and see what else they can do in the space to, you know, retention, recruitment, given the pay bills are obviously going to be, let's use the word, unfortunate from April onwards. I'm trying to be very careful and very polite. So that's my view.
You mentioned systems. Obviously, Simon is chair of well, lots of different things, but one of them is the payroll system, one of the payroll systems committee. So, where are we in relation to the system side of things, Simon? And perhaps if you can talk us through that element, and also then bring us into the double taxation myth, that'd be great.
Yeah, sure. Thanks, Nick. So payroll software developers are ready and willing to be consulted on the changes for April 26. I think that's been quite obvious in the consultation meetings that have occurred through the past year. However, I think going to Karen's comments, really, how many of those consultation meetings have actually occurred on what will happen in April 26? The answer is 0. None have occurred. So we've had a couple of presentations on thoughts and processes in some of the I call more remote consultation groupings that aren't necessarily public, but we haven't actually had the commencement. Now, it may be they're waiting for the March fiscal event to allow the progression to the next stage of consultation, because of course mandation is April 26, and they're running out of time, but there's an element of, if it's going to be developed, it all needs to be settled for the summer, because software will need to be operated. Now, in relation to payrolling now, most software probably already has capabilities. Not everyone will. Again, I think Karen's raised an important point. We all know how to do this, don't we? The question sometimes is, are you allowed to do it? And some of this activity strays into tax advice. Payroll activity per se doesn't. but benefit advice and what is taxable and its operation is, and it's regulated. So you may actually find yourselves into a regulated matter. But that goes with the other proposal, sorry, sidelining a little bit, of the government will bringing in potentially regulatory registration of all tax advice from April 26. We haven't really heard too much about how that's being progressed either, which might affect payroll as well. So we'll have to see where that goes. But the software developers are ready and willing to progress. However, time is running out rapidly.
And Matthew, then what do we need to do then with time running out rapidly in order for us to get ready for April 26?
Sorry, I get myself off mute. Yeah, I think getting ready at the moment is the question of, do you jump before you're pushed? Are you going to try and do payrolling from April 2025? As Simon said earlier in the session, you're running out of time to make that decision depending on your software and the size of your business and what benefits you want to payroll. As far as I feel, what companies need to do is to really look at the data that they hold and the data that they collect on these benefits. You know, all of the information that you currently put on a P11DB is going to have to go somewhere. And it's likely that that's going to have to be part of the RTI data. Now, we don't know at the moment what sort of changes are going to be made to the RTI data, what you're going to be expected to provide, how often you're going to be expected to provide it, for example. But let's just say that you need to provide that every pay period. Well, you need to have an accurate understanding of what your benefits are costing you at that moment in time, whether you flex those throughout the year based on, you know, your invoicing cycle might be different to your payment cycle, and it might not be lined up to your tax year. So really understanding what data you collect and is it good enough to supply through RTI, rather than having that big consolidation piece at the end of the year where, as Karen said, it might not be you that's doing that. You might sort of provide that data to someone else to try and ease the burden on your team. But once it's part of payrolling, it's going to have to be part of your team because it's part of the normal payroll process. So really thinking about those sort of data requirements. But if you want to go ahead this year, good luck. But just remember, you will need to register this year as normal.
We've had a few questions related to that. One of them, hopefully we can reassure one of our observers today, Robert, who says, you're worrying me now. We're going April 2025 and going through SAP config. Should I be worried?
Yeah, I'm thinking probably not. The question is, you may have to go through a transition into April 26. So the principle of getting your benefits identified, your suppliers identified of data, because it won't be you, they'll be coming from third parties, and there may be a variety that now have to provide. And before, historically, they've provided retrospectively, so they've looked back in time after the event, so they know the outcome of the race. Now they need to look in advance and predict what it's going to be in the future, because that's what payrolling does. So it's similar information, but instead of looking back, you're looking forward. So they'll now have to provide that going forward wise. Now, if you've cracked that for April 25, you're in a good place for April 26 or April 27, even if the data is different. But at the moment, if you've got medical, dental, I don't know, housing, loan, when they're allowed to be coming in April 26 or whatever, car, let's stick with medical and car. If you've got medical and car and you've got that cracked, the benefit is for reported together. Now, the reality for April 26 is that the config will have to change. So instead of it being, is this a benefit in kind? Yes, it may be, yes, this is a benefit in kind, A type, B type, C type, and then the software will just accumulate that into benefit in kind field A value, B value, C value, whereas at the moment it's just benefit in kind. The only difference at the moment is car is individual, and lots of people get that wrong. So even though your lease suppliers may say oh yeah, not a problem, we do this for loads, I think in 80% of cases they don't get it right when they first supply the data. They have to kind of change. But I think, yeah, April 25, don't be so worried, because if you've tackled your supplier and the data, you're in a good place for when mandation comes in. It's just a thought. And I haven't covered double
I was going to say,
taxation.
could I
We'll come
just
back
nip
to that.
in, Simon, before you do, because it's going to segue lovely into your double taxation bit. Just so that you're aware, I've come across some company car, electric car schemes, who obviously, you know, you can still do salary sacrifice for those. Please double check with your people team, your HR department, if they're the ones issuing that or whoever it is. I've had several examples of what's happening is the car company schemes who are setting these up are telling the employees to advise HMRC they've got a car. Now, if you're doing payrolling of benefits, the last thing you want them to do is that.
Yes.
And Simon will very nicely explain why you don't want that. So please check the communications. If you're not issuing the communication yourself, please check the communication that the provider is issuing, because I can tell you some of the messes that we're having to clear up because the poor employees have suffered because of it. And I'll hand over to Simon because I probably won't get a chance to say anything else now. So once again, it's been a pleasure, but I will leave about 5 to.
Thank you, Karen.
Thanks. Yeah, I think that's an important point, isn't it, Karen? Because there's old world and new world, and we need to distinguish what they mean. Because as Karen's saying, and it's just reminded me, I've seen some car schemes that are doing all the salary sacrifice, payroll benefits in kind, and reminding the employer they have to do P46 car. It's a total contradiction. If you're payrolling, you don't. So if you're payrolling, there is no P46 car, there is no P11D. It's done via FPS reporting. And so the message is really confused at the moment. And I think that's all about the transition. However, that then leads into the double taxation element of doing it that way, they will be double taxed. But that isn't because you've gone payrolling, that's because you've payrolled wrong. Now, we had a lot of questions last month, and I see a lot of discussion on social media saying when you go payrolling, you'll be hit with double tax. You absolutely won't. The double taxation myth is a P11D impact in year 2. The reason being is because HMRC don't know you have a benefit in year 1. So in year 2, when they pick up from the July or June submission of the P11Ds, they say, oh, Simon had a car last year and he's got a car this year, so I've got to collect 2 years worth. That's got nothing to do with payrolling. That's P11D. And in the old days, the P11Ds didn't used to get processed till December or January, so you get 2 virtually whole years collected in one, and then you'd be meeting the liability. When you go payrolling, that disappears. But in the transition year, the P11D effect is still there. So you won't be double taxed because of payrolling, you're double taxed because that's what happens with P11D. And you're now washing that away. But once everyone's on payrolling, there won't be any double taxation because it's real time. There's no, oh, we've just realized they had a benefit last year and we're 2/3 of the way through this year. They've got the same benefit this year. Got to go and collect it all. Here's a bill. And so just be wary that the double taxation myth isn't going payrolling. You will have that even if you don't.
Super. We're going to run our first poll in just a moment. I know Karen's got to leave us as well in just a moment also. Is there anything you want to add to the what's easy, what's hard, or the journey and the impacts? We covered everything, or should we run into our first poll? Matt, Simon, Karen, anything you'd like to add? Or indeed, Andy?
Yeah, it's just, yeah, and I think it's cars are probably the what's hard, to be honest. The others generally are easy, but the cars is, and it's not because it's very different, it's just subtly different, and you're going to be reliant on your supplier giving you data. And some of you that do P11Ds will know that they're not always particularly timely with it. With payrolling, of course, it's all up front.
I was also going to add, if I may, if you're doing it in payroll where you currently use providers to do P11Ds, what have you, is don't forget to work with your HR departments, because, you know, particularly where there's salary sacrifice involved with likes of electric cars, amount foregone. So where there's flexible benefits as we once knew it, as it was called, if you're operating that, if you're not familiar with what amount foregone opera rules are, you may want to familiarise yourself sooner.
Very good. Well, let's go to our first poll. We've had quite a few questions. I'm going to ask our panel of questions while we wait for the poll results to come in. I'm going to say a big thank you to Karen Thompson for joining us today on Payroll Question Time as well. We'll welcome you back to the next episode of the show. And while Karen slinks away to her next meeting, let's go into the next poll then. So the poll is, are you going for April 25 or 26? You can, options here for those in audio are already payrolling, switching in 2025, waiting for mandation in 2026, or not applicable. While we're waiting for those results to come in, we've got 136 of you on this poll. I think it would be great if we can get every single one of you involved in this poll. That'd be fantastic. And we'll comment on those results in a minute. While we're waiting for those to come in, though, we've got 5 or 6 questions to run through. So number one, does this mean that for every benefit we need to declare the years in advance like a PSA? Are PSAs still allowed? Does that mean we don't have to do anything different? Matthew.
So as far as I'm aware, PSAs are not going away. So that's a completely separate arrangement that you would have with HMRC to cover those liabilities for any benefits that you've provided. In terms of having to process it in real time, there is going to be an element of estimation with some benefits. Obviously, the onus will be on you as the employer to make sure that your estimation is as accurate as possible. And if you can make sure that you get that data ahead of time, that's obviously going to serve you well. But we know that there are going to be some benefits, some occasions where there might be a mid-year change and you're going to have to adjust the value of the benefit, and you're going to have to change things partway throughout the year. Again, like we said, we're still waiting on further information, so it's a bit sort of lacking on the ground, but there is the potential that we're going to see some sort of month 13 process. I don't want to call it a month 13 process because I don't think that's entirely accurate, but essentially there needs to be some process for a year-end reconciliation where you can kind of adjust those figures that you've provided throughout the year if they weren't as you expected them to be through your estimations. So we really need the detail on that. But yeah, there's going to be a bit of an element of estimation at the start of the year. There's going to be an element of rectification at the end of the year. So hopefully it's fairly straightforward and simple, but we'll see.
Super. Next question then comes in from Jacqueline. It says, for employees who receive car allowance and use their private cars for business mileage, if the employer does not pay the full 45 pence, what are the other options that payroll can advise the employee, such as giving the employee options to either claim on their self-assessments, or is there a particular calculation that can be done? Simon.
Well, there are, and there's increasingly becoming popular amongst some employers, and going back on the ruling on the mileage claims on national insurance contributions. So at the moment, predominantly that's dealt with by the employee making a claim on their self-assessment or completing an R85 form of the business expense related on the 45p minus the amount they've actually received. But it's certainly an option that we offer in our solution, is that you can set up a pay element to put through the mileage amounts with an amount which reduces the national insurance liability, because of course there's a 15% saving for the employer from April 25 for those who are paying mileage under the 45 pence, but paying a car allowance amount which is currently taxed in NI. So there are options to do available for people moving forward. The only means of saving the national insurance contribution value really is by operating through the payroll. The tax, of course, can be operated through R85 and self-assessment.
Super. Okay. Next question for you, Matthew, this time. Regarding the P46 car and not reporting if you are payrolling benefits, we are not salary sacrificed for company car. We just payroll the benefit each month. However, we were told that we had to still do the P46 car for this. Are you saying that regardless of salary sacrifice and your payroll company car P46 is not required?
Oh, I'm gonna pass on that because that's not something
Absolutely.
that I've personally had to deal with. But Simon's jumping right in. Thank you, Simon.
Yes, it's not required. If you're payrolling, you don't do P11D or P46 car, but you are required to report the car on the FPS through the payroll.
Perfect. Okay. We payroll all our benefits. The biggest issue we have found since moving over is that it is included in the taxable pay by FPS. But when DWP view this for benefit purposes, such as UC, there is always a difference due to the taxable benefit. Do you know if this is something that's going to be looked at?
There's not an issue for DWP because the amount is marked as benefit in kind on the FPS submission. So there are specific fields that mark it, and it isn't reported to DWP as earnings.
Okay, fantastic. Last couple of questions here, and we'll have a look at those poll results. What are the plans for loans and accommodation with payrolling? Matthew.
Yes, so Simon's chuckling to himself because at the moment we don't know the plans. The extent that we know at the moment is that from April 2026, those benefits will be voluntary to be payrolled. Otherwise, they will continue to be on the legacy process or the P11D process. So we would expect that there would be an amended P11D, which will only, or P11DB, that will only show those benefits that can be processed via a P11D. And there will be additional guidance on how you can payroll those benefits if you wish to. If you wish to payroll those benefits, you will have to register like you currently need to do for all the other different types of benefits. And there will be some calculations for you to determine the value of those benefits. Now, we don't expect it to be easy. This is probably the sticking point that stopped us from getting to this mandating point sooner, is that those two benefits, by their very nature, have different values throughout the year. So we need sort of a clear and structured way to calculate those benefits so that you know what you're reporting and what you're reporting is correct. So if you fancy a bit of a challenge, you can certainly payroll those benefits, but we're waiting to see what the calculations look like. And again, that's probably one of the driving forces for needing that end of year reconciliation process so that you can amend those benefits at the end of the tax year when you finally figure out the proper value at the end of the tax year.
Super. Well, let's have a look at some of these poll results. Still a couple of questions coming in, but I'm going to jump into these for a moment. For those in audio only, we've got 27% that say they're already payrolling, 14% switching in 2025, 53% say waiting for mandation in 2026, and 6% not applicable. Simon, what are your thoughts on those results?
Yeah, it's really interesting because that potentially shows a 50% growth in 25 for payrolling, doesn't it, on those existing values. So you've already got over a quarter that are payrolling and another eighth that are going to payroll, but about 50% just over that are waiting for mandation to move ahead. It sounds about right, and yeah, there will be employers that don't have any benefits, so this doesn't impact them whatsoever. However, some of the not applicables may just be because they've got nothing to do with the subject, which is why we put it there as well. So yeah, interesting. I think the switching in 2025 is a consideration, and wish you good with the journey. We'll have to wait for what the March announcement is. Nick, I'm going to make a further question on that question you asked me about earnings to UC,
sure,
if that's
sure.
okay.
Yeah, please do.
Now, software has capability to mark items as benefit in kind. Now, it isn't just simply putting something through that's subject to tax. You have to mark it as a PBiK item If you don't, that will get reported through as income to DWP. So you need to make sure that your software is capable of reporting the FPS reporting requirements. Worx, it certainly is, and others will have it. But there may be some that you think you could just push an amount through and make it taxable. That does the job. It doesn't. You need to make sure it has the PBiK capability, because equally the statutory limit 50% tax doesn't apply to the benefit amount. So that makes sense. So there are other items which you don't want to be impacted by the benefit because it's not cash. And that's all built into the FPS structure right now, has been since 2016. So make sure that your software is capable of reporting it correctly. Otherwise, it could be recording it as cash pay. But the answer is already there. It's built into solutions now if it's marked appropriately.
Super, super. Well, we've got 3 questions I'm going to finally ask. We move into our next section. Thank you for those waiting patiently who want to get their questions in for salary sacrifice. Start putting them into my questions box now. And also thank you to everyone. We had 91% of you voted on that poll, which really does give us more accurate results. So last 3 questions on this. Number 1, are people being strict with the HMRC lag of 1 month for mileage claims, i.e. the amount has to be claimed back within a month to claim the NIC against the car allowance?
Yeah. Well, I'm going to give a sort of flippant response and say no. I don't think that's a real strictness at all.
Okay, good.
Yes.
Just checking, if you're currently payrolling medical benefit when April 2026 arrives, we will need to update the pay element to deduct Class 1A NIC in real time, or will we need to update the pay element to deduct Class 1AC in real time?
Assuming that proposal goes through as announced, then yes. But for the 25, 26, no, it'll still be P11DB. But from April 26 onwards, that 12th that you're doing every month, or 52th if you're on a weekly, there'll be a real-time 15% requirement.
Super.
That's likely something that's going to need to be picked up by a software provider who'll give you help and assistance with transitioning everything across.
That's right. We already can handle for termination payments and sporting testimonials. Some people try and use that for benefits. It's not allowed to. But in effect, you could say it's the equivalent type of capability. Is it'll probably operate similar to termination payment.
Very good. I've got an observation is that annoyingly, gov.uk states that except for cars, which will be confusing, you must still report these benefits on our P11D, even if you're payrolling other benefits for the same employees.
No, not if you're formally payrolling. You don't have to do P11D.
I think the observation here is that's what
you talked about the P11D.
gov.uk is stating. I don't know if that's accurate or not.
No,
but that's what
yeah, I don't. I'm sorry, I'm suspicious that that's accurate. There is a requirement if you're payrolling to report the employer adjustment for P11DB of Class 1A. There isn't a P11D requirement for that benefit.
Okay, and finally, if we process PMI by payrolling, will we also have to submit P11DB for Class 1A, or can payroll software calculate this?
For 25, 26, you have to do the P11DB. For 26, 27, assuming it goes ahead with real-time Class 1A, you won't in June or July 27, when that would have been due, because it will actually be collected in real time.
Fantastic. Well, listen, let's move on to salary sacrifice, because this is often quite a meaty section as well. I'm conscious we've got Andy's pension section to get to and another poll. We've got time is slowly disappearing from us. So Matthew, can you give us a bit of an overview on the salary sacrifice? We've got a couple of bullet points here: avoiding national insurance increases, dealing with the sacrifice, dealing with the benefit, minimum wage, and maternity rights. Matthew, you have the floor.
Yeah, well, salary sacrifice is coming back into the conversation a little bit, predominantly because for some benefits, it can be used to reduce the national insurance contributions that an employer pays. Now that we're seeing a reduction in the secondary threshold and an increase in the percentage, that's becoming a lot more enticing to a lot of employers. So, you know, the big one we always talk about is pensions, because it's something that is, you know, mandated. Automatic enrollment, you've got to put people into pension schemes. So it's a very big opportunity cost really for a business if they decide not to go down that route. One of the big things at the moment that we're sort of really stressing, on top of these national insurance changes, we've got national minimum wage changes, and salary sacrifice can be a huge area that you need to be aware of, because salary sacrifice is an adjustment to someone's contracted pay. Therefore, that reduction in pay or that reduced pay is the pay that you need to use for your national minimum wage and national living wage calculations. So you cannot take someone below that national living wage or national minimum wage rate with a salary sacrifice deduction. So while we're seeing those increases in the national minimum wage rates, if you've got people who historically, 3-4 years ago might have been well above the national minimum wage, but in the past few years we've seen double-digit percentage increases on some of the national minimum wage rates. Are they still above that level with the pay rises you've been given? If we've got 10-12% on national minimum wage, but you've given people a 3-4-5% increase on their wages, that national minimum wage rate is catching them up. So if you've reduced their pay by 5 or 10% for their pension contribution, are you taking them to below that new national minimum wage? That's something this tax year really encouraging people to check, do your calculations, see if your software's got any sort of forecasting that can help you do those calculations and understand, are you compliant? Are all your staff on the right side of that law? And we kind of touched on it briefly earlier. We've got on the thing there, maternity rights. As we said, if you've got a salary sacrifice arrangement while an employee is on maternity leave, you cannot reduce their statutory maternity pay, but you have a contractual obligation to continue with the benefit that you're providing through salary sacrifice. So whether that's pensions, you still do the pension contribution as it should have been before they went on maternity, not on their maternity pay. If you're providing a car, they're still in your employment. You've still got a contract to supply that car, so that car is still with them. As always, there are some differing contracts of providing different benefits that you should check the fine details, because there may be some where they give the car back during that period. But as a general rule, they would still retain the benefit throughout that maternity period. So you essentially bear that entire cost. If the cost of that benefit is covered by the salary sacrifice payment for those 9-12 months, it no longer is. So you have to cover the cost of that as a business.
Perfect. And before I ask for Simon's additional commentary, so let's run to our next poll. And Simon, I'll come to you if there's anything we need to add into that. Our next poll at the moment is, have you had to remove people from salary sacrifice schemes due to national minimum wage implications? 3 simple options here: yes, no, or not applicable. While waiting for audience to vote on those responses, Simon, I wonder if there's anything you want to add to Matt's commentary.
Yeah, sure. That's great. So there is an element of what do you do if you're now in a position that salary is too low for a salary sacrifice to be applied without breach of minimum wage. And we see a number of things being applied, but you have to take great care, because many of them that are spoken of may not work. And the reason being is who, if you change a salary sacrifice to deduction, is the deduction being paid to, and what's it for? For example, if I talk about a bike scheme, if you change a salary sacrifice for a bike to a deduction, remember the bike is the property of the employer, so they're now paying the employer. Deductions for the benefit of the employer also reduce national minimum wage pay, so you haven't actually solved the problem at all. You've actually given it a status quo without any tax and NI advantage to the individual. You're still in breach of national minimum wage. And so be careful on those. What the HMRC guidance talks about is capping. And so that means is you can take up to the point of NMW not being breached, but you can't convert to a deduction instead. And also we see this often with maternity cases, that people seem to feel that they can contractually change the situation, or as Matt suggested, some may give the car back, for example, that, or change a salary sacrifice pension to another arrangement without the employee's permission. That would be potentially unlawful, and there's potentials that that would actually be considered maternity discrimination because they're actually entitled to those. So benefits are covered for the duration of maternity leave, that's potentially 12 months. Andy, this is sort of an area where you could potentially come in here, but as I understand it, Social Security law requires the employer contribution, including any salary sacrifice enhanced element, to be continued to be paid at full pay as if they're working for any period with maternity pay. You can come in, Andy, on that one.
I can confirm that, yes. So if the individual's on SMP for 39, they take their full 39 weeks, then for those 39 weeks, and in a salary sacrifice scheme, then the employer will be paying normal employer contributions plus the salary sacrifice amount, which is an employer contribution for those full 39 weeks based on the pay the person would have had they not been on maternity leave. The remaining part of unpaid maternity leave, that's down to what the pension scheme might require, which is probably nil, or what the contract between the employer and the employer has. Maybe there's additional contributions due for that period. But when they're in no period of no SMP payments, the last 3 months of maternity leave, normally there's no requirement to pay any pension contributions, but you do need to check the scheme rules and whatever contractual arrangements might be. So it's very important that even if the person's not in salary sacrifice, the employer still pays their normal contributions based on the pay the person would have had they not been on maternity leave for the whole of that maternity pay period, for all of those, the time when they're getting SMP. Salary sacrifice possibly could be recovered if the individual is receiving occupational maternity pay, in other words, other payments on top of SMP, if the agreement between the employer and the employee, the salary sacrifice agreement, allows the employer to do that. So if they get an occupational maternity pay, then whilst that is in payment, then the amount of salary sacrifice employee equivalent contribution could be recovered from OMP, possibly. Depends on how much occupational maternity pay is being paid. So yes, maternity, and think about adoption, all these statutory leave type situations, see what the scheme rules require, because the scheme rules may require bigger contribution than what you might think from a statutory perspective. So check the scheme rules as well. I think the other thing I'd say, just on the salary sacrifice in terms of pension, is you can, if you've got a bonus scheme in place, then you could, the employees could sacrifice all or some of their bonus as an employer contribution. The individual shouldn't be aware of the amount. That's my understanding. They don't, but they could say, I want to give 50% of my bonus. I want to give £1,000 of my bonus as a salary sacrifice amount, i.e. to give a part of your bonus in exchange for an additional employer contribution. So that would save employees national insurance on top of the normal tax relief set up. But obviously, if you are sacrificing bonuses, then that's more potentially, especially for the highly paid people, they could trigger the breach in the annual allowance of 60k towards a pension scheme, E's and O's in the year. So there's other things to consider in that calculation in terms of bonus salary sacrifice. Probably my thoughts. Anything to add, Simon or Matt?
Yeah, just a question for you, Andy. With the 60,000 limit, my understanding is there can be some form of carryback for 2 years,
Indeed.
Is it?
Yeah, indeed. I would suggest, if you ask that question, if you can see someone is clearly E's and O's contributions are going to breach the 60, as a payroll person, it might be nice to say to someone, you need to seek advice, and don't get involved as payroll. But obviously, because pensions advice is financial advice is regulated, So IFA should be involved and stuff like that. Or you could refer them to the pension scheme. But yes, you're right. Yeah, it's not. There's cost of transition from carry forward and stuff. It's more complicated, and as we know in payroll, everything is complicated. It seems simple, but then you get to detail and you think, oh no, it's not that straightforward.
Well, you'll be pleased to hear, Andy, that Ashley Dorman commented to say that employers can reduce maternity enhanced top-up payments, which you mentioned before you started to speak. And then after I finished with your end of your response, you wrote spot on. He just covered it. So I hope that's helped some people out there as well. We've got a couple of questions that have come in. Just before we jump into those, Matthew, any observations on the results? 51% have said that they. The question was, have you had to remove people from salary sacrifice schemes due to national minimum wage implications? And 51% have said yes.
Yeah, that is higher than I anticipated it to be. As I said earlier, I think we're kind of talking about this a little bit more in relation to salary sacrifice and national minimum wage, but to see over 50% saying they're having to take people out is concerning. And I suppose we've had conversations with the Low Pay Commission regarding this as to whether it's something they want to take up with the government, because, you know, particularly in the case with pensions, if you're removing someone from a salary sacrifice scheme and putting them in a net pay arrangement or a relief at source scheme, then the end result is that exactly the same amount goes into someone's pension pot, but they are worse off in their day-to-day pay packet because they don't get the national insurance relief from that. So, and also that deduction can take them below national minimum wage because it is not a deduction that is for the employer's own use and benefit. It goes directly to a pension scheme. So we've got a situation where the employee's worse off, the employer's actually worse off because they don't get the relief either, and we're now below national minimum wage. So there's a lot to consider here, because essentially what we're then asking is, do we allow salary sacrifice to take people below national minimum wage in certain situations? Which is obviously a very dangerous path to go down, because we of course don't want national minimum wage regulations breached for anything. But there is the element, really, for me personally, of the pensions, where it's such a huge scope because of the amount of people it will impact, that I feel that we need to have that conversation as to what can happen here in terms of allowing salary sacrifice and understanding that it has a tax benefit. I've spoken to Simon before about equalising the tax position on the relief at source and the net pay arrangements. Obviously, that's an impact to the Treasury if we sort of give those NI relief as well. It's a big political mess, to put it simply.
Yeah,
Excellent.
The government could just solve this one, which I think is what Matt's referring to. If they just said pensions were free of tax and NI, then it wouldn't matter. Because just clarify a couple of points, Andy may comment as well, I'm not sure, but genuine employee pension contributions don't affect national minimum wage pay. Share incentive plan purchase doesn't affect national minimum wage pay because they're actually accepted exemptions to NMW regulations. Salary sacrifice always does. The important criteria on considering the maternity cover aspect, because an employer could say, oh, I'm now on the hook for continuing contributions, is look at your ratio of numbers of those that are on maternity or parental leave or not. Because in theory, and this is why employers are interested in this, but NMW is the counterbalance that you have to consider, is that for every £1 million contribution made, that's £150,000 saving for the employer, minus its coverage of any SMP cases where it has to continue the arrangement. So for some, if you do the maths, there may be considerable savings in salary sacrifice arrangements. However, you have to balance that. It's like a seesaw effect with the implications of maternity rights, continuing payment, and national minimum wage breach.
Well, conscious of time and conscious I want to make sure we've got enough time for Andy's pension section. I've got a couple of questions I want to quickly run through, and I'm going to give you the floor, Andy. One is an observation, actually. One thing to ensure, which I think we've kind of covered, but it's good just to remind the audience, one thing to ensure is that when the national minimum wage or national living wage rate changes, to reassess and address those breaches where necessary. That's one thing that affected our business, where national wage, national living wage percentage increases is much more than the percentage applied to our standard pay reviews. And you can see our panel nodding along there, Jess. Thank you for that. Jacqueline has said, what about when the software switches the employee from pension salary sacrifice to a net deduction due to the earnings being low to avoid the national minimum wage breach? I'll come to you for that one, Simon. It's a software related question.
Well, it may not affect the national minimum wage position at all, because why is that happening? Is the choice of the employer to operate that? So it may be seen that that's a deduction for the benefit of the employer. So I tend to view that it's an element of seek your own professional advice, but my personal view is flipping doesn't work.
Okay. Andrew's made an observation, actually, which is I think a bit of a challenge or an observation based on your comment, Andy, about not knowing the bonus. Said the employees can know the bonus amount when making the sacrifice. They must elect to sacrifice it the month before the payment of the bonus. Does that sound correct?
Yeah, he can't be paid. Yeah.
You can't be subject to actually being paid, so it's before it's contractually due that you have to make the sacrifice.
Yeah, so it's okay if the bonus is known as long as it's done in advance. Yeah, okay. Last question here. Where is the best, I'll confuse this one, Matt, because I might know where the answer might go. Where is the best guidance, or where can we get the best guidance for working out and ensuring that you are compliant with HMRC when being asked to provide a loan to an employee?
Oh, good question. Really, the legislation is the best place to look for 100% compliance, but legislation is complicated and it's not very easy to read. So the next best place is usually gov.uk. It's always important to remember gov.uk is HMRC's interpretation of the law, not necessarily the law, but they're obviously the ones going to be enforcing it. So gov.uk is going to be your best bet. And then professional publications, CIPP, Payroll Centre. Simon puts out things regularly, so have a look around and I'm sure you can find something that will help you out.
Perfect. And last one on his list, could you clarify salary sacrifice pension whilst an employee is on maternity leave with no pay, please? Is the employer contribution still the value that would have been used if the employee had sacrificed salary, or would it only be the employer contribution ignoring any amount that the employee would have sacrificed?
Well, a comment, there is actually, Andy will chip in, I'm sure, there is absolutely no requirement for an employer to make contributions through a period of non-pay. But during periods of pay, any pay, the requirement on the employer contribution is it's based on full pay earnings as if they were working.
So the only caveat to that is, which is unlikely to be honest,
scheme rules.
If the scheme rules require the employer to continue to pay employer contributions during a period of unpaid maternity leave, then you're going to have to pay it. Very unlikely, not come across it, but in theory it could be there. Or if the contractual agreement between the employee and the employer says during maternity leave, the whole maternity leave, the employer will pay contributions on full pay, then so be it. But normally it's just when the person is in receipt of their SMP, up to 39 weeks period.
And while I've got you there, Andy, if employee go slightly separate questions just dropped in. If employee will go below minimum wage because of auto enrolment pension scheme, is salary sacrifice. If we don't switch them to the net pay scheme, we'd be in breach of pension auto enrolment rules, correct?
Yeah, they need to pay their contributions, yeah. So I think you probably find most employers will take them out of salary sacrifice and put them into the net pay or relief, whatever the normal tax relief method is. So if it was a nest pension scheme, relief at source. If it was now, it'd be net pay arrangement. So to just take normal contributions. But you do need to look at what your salary sacrifice agreement is with the employee, because you want to make sure you're following what has been agreed legally. And I have seen employers whose salary sacrifice agreement takes them out of salary sacrifice when they go maternity leave and puts them into normal contributions. And I'm thinking that's, maybe it's legally okay, but to me that is unfair, particularly as the SMP has been calculated on post-sacrifice enable pay. So their SMP is lower because they were in the salary sacrifice arrangement, and now you're going to pay them the lower amount of SMP based on a lower enable pay and not give them the advantage of salary sacrifice. I mean, that's a legal employment law thing.
Exactly. You potentially say that the contract breaches the Social Security Act.
Mm.
And is the pension shortfall applied to every pension scheme or only certain ones?
Defined contribution primarily, defined benefit, if it's giving them the service entitlement, contributions go out of the picture because they're getting the entitlement based on their service and final salary. But with DC schemes, it applies to all pensions, I'd suggest.
Yeah, there's
Last
a minimum.
question. Sorry, go on. Oh, they're all flying in. I've got a whole pension section here, but these are all pensions-related questions, Andy, so I'm going to keep you on the hot seat for a second. We may run over by a couple of minutes. I hope that's okay for our attendees. We want to make sure we don't miss anything.
Go on to the next slide, if that's a pension.
To be honest, my pension section is just forward.
Well, I know, you always get put to the back, Andy. This is not the first time it's happened, and that's why Simon's chuckling along. For those interested in the SD Worx Academy, I put the dates in the chat box, so you can copy and paste that along with the link to SD Worx, so you can find out those. We're not going to get to that section today. I've also put a link to the latest episode of the Payroll podcast, which if you're interested in getting to the executive level, or you believe strongly that Payroll should have a seat at the table, it's an episode I highly recommend you have a listen to. Anyway, next question here is if an employee is on mat leave but receives a bonus, should pension contributions be paid?
Is bonus pensionable? That's down to scheme rules. So it could be your scheme is salary only, but what is their normal pay? So you should be taking contributions based on the individual. If they're just paying normal contributions, that you base it on whatever pensionable pay is being processed in that particular pay period. The employer pays as if it's based on what they would have had paid. So
just give me a follow-up to the same question. They've just sent me a follow-up to the same question with an asterisk saying nil pay due to mat leave but receives a bonus.
Well, it's not nil pay then, is it, if they've received a bonus? So
you're saying
the bonus is not pensionable. We're in real life chat.
Yeah.
Okay. Diane's put another question here very quickly. The LGPS, TPS, and Nest, we do the employer pension shortfall for sickness and maternity, but what about Aviva and Royal London?
It's required.
Yeah, you can't underpay pension, but as Simon said, if it's a DB scheme, then contributions are what you pay, E's and R's, is irrelevant to what pension you're going to get. It's all about, you'll know, those who've got DB schemes will know that the information you're passing to the pension provider is length of service. This is pensionable length of service, etc., so that they get their pension calculated. E's and R's contributions are due under whatever the scheme rules require. And ultimately, the employer is responsible to ensure there's enough money in the pension fund, the DB scheme, to ensure the last person, whoever entitled to a pension, gets paid their pension. DC, on the other hand, what you pay in is what you get out as a pension. So you've got to make sure that minimum contributions, whatever the contributions are in the scheme rules, that's what it's got to be paid over.
We've had a few thank yous coming in, so I think that has landed, which is great. So last but not least, we've got a couple of minutes. We're going to run over, Andy. Tell us a little bit about pensions. While let me read out the slide, I'll let you take the floor.
Well, we know that this is so quick. So relief at source net pay arrangement, if you don't pay tax as an individual, then you will end up with relief at source, you automatically get tax relief. You will pay less, and you'll pay less as an individual, because your tax relief bit is covered by HMRC. But if you're in a net pay arrangement, you'll end up paying the full contribution. You won't get any tax relief on it. HMRC said some time back that they're going to fix that anomaly for the non-taxpayers. So for the 24-25 tax year, this tax year, they will calculate the amount of tax relief an individual in a net pay arrangement should have had, but didn't get because they're a non-taxpayer, they don't pay tax. And that will be paid to them, maybe up to 70 quid. Will be paid to them sometime in 2026. That's the best they've said so far. So from now on, anyone who's non-taxpayer who's in a net pay arrangement scheme and therefore hasn't got the full tax relief on their pension contributions will have that offset, and they'll get the money paid direct by HMRC at some point in future years. The changes to automatic enrolment, the age reduction from 22 to 18 and the lower threshold going to 0, Not surprisingly, that's all on hold, given the massive increase in employers' national insurance. Then trying to change those rules will be another big impact on employers. So we just wait to see when that's going to come back into play. The pension providers have all said we want more money paid into pension schemes because people need to have more money in the pots to have a better standard of living in their retirement. Also for pension providers, more money in pension pots, the more income they receive. But we see what happens. It's always been a thought that employers and employees should pay more to get a bigger pension pot, but at the moment that's not viable. And how to prepare for pension-related changes? Well, see when they come up. There's big changes to inheritance tax, but that's individual, not employer, which may or may not happen. Do the consultation if you want to give your feedback on that bit. There'll be plenty of time warning about automatic enrolment changes. So, and there'll be consultations before those things happen. So that's plenty of feedback on there. And we've already discussed in terms of how to lessen the employer national insurance issues, and maybe look at salary sacrifice. If you don't have that in place, introduce perhaps a salary sacrifice scheme. But obviously you need legal advice, change of contracts, discuss with your pension provider, make sure that is possible to do that, discuss with your payroll software provider to understand how you go about changing the payroll system, and of course consult with your employees.
And Thomasina has asked a question, salary sacrifice pension schemes, how does it work when you convert a percentage of employer savings from a payroll perspective?
Well, in effect, you're going to be setting up an element within your payroll system, which is the equivalent of an employee contribution, but actually it's a negative pay. And so if it's 10% of your pay, then you're going to, if that's your pension contribution, your salary is £2,000, 10% is £200, then your salary sacrifice element on your payroll system is minus £200. And that then, when you transfer that amount over to the pension provider, that's your £200 additional employer contribution. So it's a negative allowance. Is the salary?
Yeah, your employer pension contributions is the totality of the pension contributions. So I'm in a salary sacrifice scheme. When I go look at my pension scheme, it shows us all an employer's contribution because I've technically contributed nothing. I've taken a reduction in my salary in exchange for my employer doing more. So if you want to also provide the NI relief that you get because of doing that, you just add that on top of it when you make that deduction and represent that on the payslip.
Right.
Well, yeah, thinking employee-wise, that's quite tough because you've got potentially 3 bands of contribution: 0%, 8%, 2%. So how do you work that out when someone's crossing those bands? And that's quite tough. So you may just have to make a guess.
We may have to
For employer contributions, it's easy. It's 15%.
Yeah, in a future one. For those, obviously we've got next PQT is going to be in March, but there are a couple of courses from the SD Worx Academy which are taking place before the next PQT. So if you are interested in finding out more about payrolling benefits in kind, there is an SD Worx Academy course on the 14th of March. If you're interested in finding out more about national minimum wage, it's an advanced course, then that takes place on the 19th of March. All the other courses we've listed in today's episode actually don't take place until April, so there's plenty of time to sign up for those. But those 2 particular ones are of interest, do go to the SD Worx website where you can sign up. Of course, the next PQT is going to be on the 27th of March. You can sign up now at sdworx.co.uk/PQT. For anyone that missed last month's episode in January, I've just put a link into the chat where you can access the audio of the last PQT as well with the Payroll podcast. And just leaves me to say a huge thank you, and thank you also for your patience, Andy, for running through that at such speed at the end of the show. So Andy Nichols, Simon Parsons, and Matthew Krieger, and of course Karen Thompson, who left us slightly earlier today. Thank you ever so much for your wisdom and your expertise. I've been your host. My name is Nick Day, and I look forward to bringing you the next episode of PQT on the 27th of March. 116 of you stay till the end. Thank you ever so much for your contributions in the polls as well, and we'll look forward to seeing you in a month's time. Thank you very much.
Bye.